The reason why this is so significant is because housing affordability has dropped to essentially the lowest level ever, and it's very easy to understand this when we look at 2021 to now to potentially where we might be next year, because this home in 2021 might have sold for $500,000, and if you put down 20%, that would mean $100,000, and you could get a 2.5% 30-year fixed rate mortgage locked in, and this means that your monthly payments would be $1,580 a month just on your mortgage. We're not looking at property taxes, we're not looking at insurance. In 2022, between 2021 and 2022, we've seen home prices grow by just over 20%. So if we assume that home prices grew by only 20%, that means the same home with no additional modifications is going to cost you $600,000. So you're going to put down the same 20%, which would be $120,000. But now if you want to go and get a fixed rate 30-year mortgage, you're not paying 2.5%. You're hovering at close to 6.5%. This is about double where we were in the beginning of 2022, just 6 or 7 months ago. And so now this same home is going to cost you not $1,580 a month, but $3,000 a month on your mortgage if you get it at 6.5%. And this is not including now the higher property taxes that you're going to have to pay because the home is more valuable. And you're also going to have to pay a higher insurance rate because you're insuring a more expensive home, even though it's the exact same home as here. Now, if we fast forward to 2023, where what people are projecting of what's going to come in the future, everyone is saying that we can expect home prices to grow by another 5% or so over the next year, which means this home will be $630,000. Now, if you're going to put down the same 20%, that's $126,000. And at this rate, if the Fed stays true to fight inflation and they keep raising interest rates the way that they say that they will, well, we could see mortgage rates hit around 10% next year. And that means now your monthly mortgage payment is going to cost you around $4,400 on this exact same home, assuming no modifications. And now you also have the higher property taxes and the higher insurance on top of the higher mortgage payment. The reason why these numbers have been growing so significantly is because not only are you borrowing more dollars, but you have to borrow the dollars at a higher price. You have to pay more interest on these dollars. And if we assume the mortgage rates go up to 10%, if you can only afford a $3,000 monthly payment, well, that means the max that you can borrow at 10% is $350,000. In this instance, you're borrowing about $500,000. And if you want to afford a $1,600 mortgage or $1,580 mortgage, the max amount of dollars that you can borrow would be $180,000. Here, you could borrow $400,000 at the 2.5% to get a $1,580 mortgage, but at 10%, you could only borrow $180,000. Here, you could borrow $480,000, but at 10%, you can only borrow $350,000. This is why adjustable rate mortgages have been making a comeback, because people are looking for an alternative to get a lower mortgage rate again. So 2008, the whole financial market meltdown was triggered by the real estate market, the housing market. So the housing market started with these three things: the housing market bubble and bust. You had first ninja loans, which stood for no income, no job, no asset loans, meaning if you didn't have an income, you didn't have a job, you didn't have any assets, and you walked into the bank saying, I want a $200,000 loan to buy a home, they would say, no problem. You can get a home with 0% down. 0% down payments were very popular. In fact, they had some loans where you could get 110% loan to value loans, meaning if a home is $100,000, they wouldn't just give you $80,000 or $90,000 or $100,000. They would give you $110,000 to cover your closing costs, to cover your move-in costs, because everybody thought home prices could never go down. So banks were literally giving you free money to go out and buy a home because everybody thought home prices could not go down. Then you had subprime mortgages as well, which was where you had a very low credit score. You should not have qualified for a mortgage, but banks were able to give you the subprime loans, meaning loans with a higher interest rate. and they were able to find ways to give you loans even though you shouldn't have gotten one. And then you had the adjustable rate mortgages, which is what we're seeing right now, which is where you would get a low teaser rate in the beginning. So you'd have a very low mortgage rate for the first few years. And then as interest rates went up, the mortgage rate readjusted. And then all of a sudden you were slapped with a much higher mortgage rate that you couldn't afford. And this get a lot of people in trouble. And then you had the Wall Street issue. The Wall Street issue was now banks were making all these mortgages, and everybody on Wall Street said, well, let's get in on the fun too. So then everybody on Wall Street started chopping up these mortgages, selling them as different investments and as different securities. And this went on and on and on. This created this huge domino effect so that when the housing market started to fall because of these three things, then Wall Street essentially was on the verge of collapsing. But it started with the housing market. In 2022, our economic slowdown is not being caused by the housing market, it's being caused because of inflation. So a very different trigger. Yes, we have adjustable rate mortgages today. Nowhere near what we saw before the 2008 crash yet. However, adjustable rate mortgages are growing, and we do have, everything going on with Wall Street, but we do not have the subprime lending. We do not have the same ninja loans the way that we did before the 2008 crash. So what does this mean? Well, the economic issues today are different than the economic issues that led to the 2008 crash.
Thank you for watching. If you enjoyed the shorter clip from my longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.